Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video we're going to be going over FAR Area 1, Section E, and this is an application topic, perform calculations to convert cash basis or modified cash basis financial statements to accrual basis financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, that is one of our main strategies, again, diving straight into the questions. Instead of watching hours of lectures or spending hours reading your textbook, instead you dive straight into the thing that you're going to be doing on test day, which is answering multiple choice questions and sims. That's what you should be practicing. So if you want to learn more about that, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam. And again, it's only 1 hour. It's free, so definitely go check it out. Also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos, again, make sure you go check out that free 1-hour webinar training and see if you want to become a SuperfastCPA member, because again, you get access to those full 10-question videos and a lot more, of course. With all that said, let's dive straight into the questions. All right, here we are at question 1, and one thing I want to say as we're diving into these, of course, we're not going to cover every single little detail and every single little thing about converting from cash to accrual, but what I do believe is that if you can learn the concepts, learn the basic understanding of how converting from cash to accrual works from these questions, then no matter what question you see that has to do with converting from cash to accrual, you'll know how to do it, because the concept really transfers to pretty much anything you do when, again, converting from cash to accrual. So I just wanted to say that. Now let's dive into question 1. You should always read the last part of the question to give yourself context on what you're looking for. What would the total net income be on an accrual basis for the current year? Okay, so we want to know what the net income would be on accrual basis. So with that knowledge, we go up here. A corporation keeps its records on cash basis. That's obvious based off of the video we're doing. Accounts receivable at the end of the previous year was $50,000. Accounts receivable at the end of the current year, $70,000. Accounts payable at the end of the previous year, $30,000, and accounts payable at the end of the current year, $20,000. And then they had cash basis net income for the current year of $300,000. So with this $300,000 net income and knowing the changes in accounts receivable and accounts payable, we need to figure out what the accrual basis income would be compared to the cash basis income. So if you have an idea of how to do this, that's great. Go ahead and pause the video and do the calculation. If not, that's okay. This is the first question. We're kind of getting an understanding, taking a first step into how to understand this. So let's go to the answer if you haven't already tried to answer it yourself. All right, here we are at the answer. The answer is D, $330,000 would be the accrual basis income. Let's walk through this. To convert from cash basis to accrual basis, we adjust for changes in accounts receivable and accounts payable. So for adjusting accounts receivable, this is one way you can do it. You can add the ending accounts receivable. So that would have been the accounts receivable at the end of the current year. And then you can subtract the beginning accounts receivable. That would be the accounts receivable at the end of the previous year. So when you net those, adding the ending and subtracting the beginning, you get a $20,000 increase in accounts receivable, or really a $20,000 increase in income. And we're going to dive a little bit more into this in the other questions. But if you think about that, if accounts receivable increased by $20,000 throughout the year, and that makes sense because it ended at $70,000, it began at $50,000. Under accrual, that would mean that's $20,000 more of income. But under cash, they would not have necessarily recognized this extra $20,000 of income by the accounts receivable increasing. They only are going to recognize it when they receive the money from those accounts receivable. So compared to cash, the accrual amount would increase by $20,000 because of these increase in accounts receivable. Next, for adjusting accounts payable, it's a little bit different. Instead of adding the ending accounts payable, you actually subtract the ending accounts payable, and then you add the beginning accounts payable. So down here, you would take the beginning accounts payable and subtract the ending accounts payable, and that means that the accounts payable has decreased by $10,000. Now, let's think about this. If it decreased by $10,000, that means that under cash, they paid $10,000 of payables off, so that would have decreased the net income for under cash basis. But under accrual, just because accounts payable went down doesn't necessarily mean that the net income goes down, because again, if you think about it, under accrual, they already recognized the expense under accounts payable. So these expenses that cash is recognizing have already been recognized under accrual, So you actually add it back to the net income. And again, we're going to dive deep into all of this continually throughout the rest of the video, so don't get too worried. But again, this is how you can do it. You can add the ending AR, subtract the beginning AR, subtract the ending AP, and add the beginning AP, and that will give you the increase to net income for the year. So if we go down here to the cash basis net income, you add the ending AR, subtract the beginning AR, add the beginning AP, subtract the ending AP, and that gives you $300,000 plus the 20 plus 10 is $330,000. So again, this is just an intro question. We're going to dive much more into it in the next questions. So let's go to question 2. All right, here we are at question 2. Let's always read the last part of it. Based on this information, what is Sunridge Manufacturing's accrual basis pre-tax income for the current year? Okay, so we're, again, of course, trying to figure out the accrual pre-tax income. Sunridge Manufacturing, a company specializing in solar panel production, keeps its financial records on a cash basis. For the current year, the company reported a cash basis pre-tax income of $500,000. During the year, the company's accounts receivable decreased by $35,000, while its accounts payable increased by $22,000. So based off of $500,000, a decrease of accounts receivable of $35,000, and an increase in accounts payable of $22,000, what is the accrual basis income compared to the cash income? Now, based off what you saw in the previous question, you could potentially think through this and know what the correct answer is. If you want, go ahead and pause the video and kind of think through this to see if you can get the right answer. If not, let's dive into the answer together. All right, here we are at the answer. The answer is A, $443,000 would be the accrual basis income. Now, let's dive into this so that you can get a deeper understanding. Again, if you can understand this concept, you could apply this to almost anything, or you could apply it to really anything when you're converting from cash basis to accrual. So make sure you understand this. Cash basis accounting only recognizes revenue and expenses when cash is actually received or paid. In contrast, accrual basis accounting recognizes revenue when it is earned and expenses when they are incurred, regardless of when the cash changes hands. So that, of course, leads to some timing differences, which is why cash and accrual can be different very frequently. Let's talk about what happens when accounts receivable decreases. Under cash basis accounting, income is only recognized when cash is received. However, in accrual accounting, revenue is recognized when earned, not when collected. If accounts receivable decreased by $35,000, under cash basis, that would mean money was collected this year for sales in a previous period, therefore increasing income. So under cash basis, if accounts receivable decreases, that means you got money, you got cash, so you increase your income. However, under accrual accounting, this income would have already been recognized in a previous period. Because it was accounts receivable, they recognized that income when the accounts receivable happened. So to avoid double counting, this decrease in AR must be subtracted when converting from cash to accrual. So again, you have to think about this. For cash, it only matters when money moves, when the cash is received or when the cash is paid. But with accounts receivable, this $35,000 and any other accounts receivable that's already there was already recognized in income under accrual basis. So to avoid double counting it, because cash is counting it already and accrual basis is already counting it already, we need to subtract it because we already recognize that income under accrual. So think about that. Let's go to accounts payable. When an accounts payable account increases, under cash basis accounting, expenses are only recorded when cash is paid. In accrual accounting, expenses are recognized when incurred, even if the cash hasn't been paid yet. Since accounts payable increased by $22,000, it indicates that more expenses were incurred but have not yet been paid. These unpaid expenses reduce income on an accrual basis because accrual accounting recognizes them as obligations during the current period, while on cash basis, these expenses wouldn't have been recorded yet. So to convert them from cash to accrual, these expenses need to be subtracted since they weren't recognized under cash basis accounting. So you have to, the whole thing behind this whole video really, and this whole topic, is understanding the timing of cash and accrual income and expenses. If an accrual account increases, that means that there's more accrued expenses. Under accrual basis accounting, that means that that's more expenses, you have to record them. Under cash, you're not recognizing it until you've actually paid those expenses. So that's where these differences come in. You have to subtract those expenses that haven't been recognized yet under cash basis, and you have to also subtract the income that it was already recognized on accrual basis but hadn't been recognized yet under cash basis. So be thinking about these things throughout the rest of the video. With what we understood just barely there, when it comes to converting from cash to accrual, you take the cash basis pre-tax income, subtract the decrease in accounts receivable, subtract the increase in accounts payable, and that gives you a total of $443,000 of accrual basis income. Now, again, think about these things as we go through the rest of the video. Be trying to understand the concept of the timing when it comes to cash and accrual. Let's go to the next question. All right, here we are at question 3. Before we do anything, based on this information, what is the cash basis income for year 3 and what is the accrual basis income for year 3? So we need to figure out both incomes for year 3 specifically. So that's why we read this, because now as we're reading through this, we only have to pick out what affects year 3 for cash and for accrual. So now let's go up here. XYZ Corp provides the following information about its sales and cash collections over the past 4 years. In year 1, the company made $120,000 in sales. Cash collections from these sales were $60,000 in year 1, $40,000 in year 2, and $20,000 in year 3. Oh, something to do with year 3. In year 2, the company made $180,000 in sales. Cash collections from these sales were $90,000 in year 2, $60,000 in year 3, $30,000 in year 4. In year 3, the company made $240,000 in sales. By the way, year 3, that's important. And the $60,000 in year 3, that was also important. Cash collections from these sales were $120,000 in year 3, again, important, and $120,000 in year 4. In year 4, the company made $200,000 in sales. Oh, wait, none of this has to do with year 3 at all. So we don't even really need to read this last part, because we know we're only looking for year 3 amounts for cash and for accrual. So with all this information that we just read, I know it's kind of a lot of information, but specifically we're focusing on year 3. So that should help you kind of pick through and understand how to figure out the cash and how to figure out the accrual income based off of the information here. So go ahead, pause the video. I think you could figure this out based off of what we've talked about so far. And when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. The answer is A. The cash basis income would have been $200,000 and the accrual basis income would have been $240,000. So let's think through this. Again, it's very logical when you take the time to think through what cash basis accounting is about and what accrual basis accounting is about. For cash basis income, under cash basis accounting, income is recognized when cash is received, regardless of when the sales were made. For year 3, cash collected includes $20,000 from year 1 sales, $60,000 from year 2 sales, and $120,000 from year 3 sales. And let's go back up here so that you can see where that's coming from. So year 1, they had these sales, $120,000 in sales, but they didn't collect cash for these sales until the following years. Year 1, they collected $20,000 in year 3. For the year 2 sales, they collected $60,000 in year 3. For year 3 sales, they collected $120,000 of those sales in cash in year 3. So that's what we were looking for when it comes to cash. We were just looking for the cash that was collected in year 3. So with that knowledge, we were able to calculate the $200,000 cash income. Now let's talk about the accrual basis income. Under accrual basis accounting, income is recognized when it is earned, regardless of when cash is collected. This is actually the easy part. For year 3, the company earned $240,000 in sales, so the accrual basis income is $240,000. And let's go up here and look at that to see what's happening. Again, it said they had $240,000 in sales. It gave us the answer right there. So even though the cash wasn't collected for all of the sales in year 3, only half in year 3 and then the other half in year 4, all of the sales occurred in year 3. And as far as accrual accounting goes, that is income. So we go down here and that's the easy answer, $240,000. So I hope that you're kind of starting to see it's not too difficult if you think about how cash works and how accrual accounting works. Let's go to the next question. All right, here we are at question 4. As always, read the last part. Based on the changes in receivables and payables, what is the accrual net income for the year? Okay, so we're looking at what's happening here to see the changes, to see how that's going to affect the cash income when you're converting it to accrual income. Anderson Co. provides the following beginning and end of year balances for its payables and receivables for the current year. Accounts receivable, beginning balance $120,000, ending $135,000. Interest receivable, beginning $15,000, ending $11,000. Rent receivable, beginning $25,000, ending $28,000. Accounts payable, beginning $40,000, ending $36,000. Interest payable, beginning $5,000, ending $7,000. wages payable beginning balance of $10,000 and ending of $12,000. The company's cash basis net income for the year is $400,000. So I know that's a lot of information. Think about what we went over in question 1. Now, something I will say, in this question, I'm going to show you another way of thinking about how to figure out how these affect the accrual income when you're converting from cash to accrual. If you remember what we talked about in the first question, you can apply that here. Or again, like I said, in the answer, we're going to talk about something different. But pause the video, see if you can do the calculation and figure out what the difference or what the accrual basis income is going to be. And when you're ready, come back, we'll look at it together. All right, here we are at the answer. The answer is C, $414,000. So if you got that right, that's awesome. And again, I'm going to kind of walk you through one of the ways you can figure out how these changes affect the accrual income when you're converting from cash to accrual. So let's talk about the explanation here. When converting from cash basis to accrual basis, here's the general rules that you can apply. And again, you can pretty much apply this to anything when you are converting from cash to accrual. This is the topic and the concept that you need to understand. For current assets and receivables, you add increases in current asset accounts because revenue was earned but not yet collected. And again, think of this as going from cash to accrual. So for cash, since nothing was collected, they hadn't recognized it yet. But under accrual, the accounts receivable went up. That means that they are recognizing revenue under accrual. You subtract the decreases because of the opposite. Cash was collected, but you already recognized the income under the accounts receivable accrual method. So it's already been recognized, so you need to subtract it from the cash basis so you don't double count. And then for current liabilities and /payables, you subtract any increases in current liabilities because these expenses were incurred but haven't been paid. So again, you are incurring them, they're expenses according to accrual accounting, but under cash accounting, they hadn't expensed those yet. So under accrual, you need to subtract it because it hasn't been subtracted yet. And then you add decreases in current liabilities because expenses that were incurred in a prior period, they've already been recognized. You don't need to double count them, so you add them back because cash is recognizing something that was already recognized under accrual accounting. Now, some of you may have noticed that this is all pretty much exactly the opposite of when you are doing the indirect method for operating activities for the statement of cash flows. So if you know how to do the statement of cash flows, basically just reverse what you do on the statement of cash flows and you will know how to go from cash to accrual, because statement of cash flows, you're typically going from accrual to cash. But now we're going from cash to accrual. So again, just keep this in mind. This is probably the most important thing you need to know or remember from this whole video. For current assets and receivables, when you're converting from cash to accrual, you add increases in AR, you subtract decreases in AR. So just that one's kind of straightforward. But for liabilities, you subtract the increases and add the increases. Okay, now that we know how to do that, and again, you can apply this rule pretty much always for cash basis to accrual, let's go down here and apply it to the rest of this. I know at the beginning of the video, in the first question, we were talking about adding ending AR and subtracting beginning AR, but then you subtract ending AP and add beginning AP. A little bit confusing. I think this is a little bit easier of a way to think about it based off of the rules we just talked about up here above. So again, I think this is the easiest way to do it. To find the change in each of these accounts, in the accounts receivable accounts and the accounts payable accounts, you need to subtract the beginning balance from the ending balance to see if the account increased or decreased. Because in my brain, I think it's easier to just think of it's increased or it's decreased. You do the same thing for each of them. You don't do something different for beginning AP and ending AP compared to beginning AR and ending AR. You just do it the same way, but you know how to treat those increases or decreases based on it being a liability or an asset. So again, you subtract the beginning from the ending, and that's how it's going to be for all of these. So all of these calculations that you see, I am subtracting the beginning balance from the ending balance. So for receivables or current assets in general, accounts receivable increased by $15,000. How do we know that? We took the ending of $135,000, which is bigger than the $120,000. You subtract 135 less 120, that means that accounts receivable increased. So we add $15,000 to the cash-based income. Interest receivable decreased. That was the ending of $11,000 less the beginning of $15,000. So since we know it's a receivable and it decreased, we subtract that to get to the accrual income. Rent receivable increased. That was the ending 28,000 less the beginning 25,000. So again, you can tell it increased because this is the ending one. So we add $3,000 because again, receivables, current assets, when they increase, you add them to the cash basis income. When they decrease, you subtract them from the cash basis income to get the accrual income. Now let's talk about payables or current liabilities. Accounts payable decreased, and we know that because the ending was 36,000, the beginning was 40,000. So there's a negative $4,000 there. It decreased, but because it's a payable, it's the opposite, so we add it, $4,000. Interest payable increased by 2,000. Again, that's the ending 7,000 less the beginning 5,000. That means that it went up. Since it's a payable, we actually subtract that from the accrual. And then same with wages payable, that increased by 2,000. That was 12,000 ending less the 10,000 beginning. We subtract that from the cash income. Now, I hope this is all making sense so far. I know that it might be a little bit confusing, but basically just think of it as the reverse of when you're converting from accrual to cash when you're doing the cash flow statement, if you know how to do that. The answer was $414,000 because you start with the cash basis net income, add the increase in accounts receivable, subtract the decrease in interest receivable, add the increase in rent receivable, add the decrease in accounts payable, subtract the increase in interest payable, and subtract the increase in wages payable, and that gives you $414,000 of accrual income. With that, let's go to the next question. All right, here we are at question 5. As always, read the last part. Based on these events, how much will James' cash basis income for August change when converted to accrual basis? Okay, so we're focused on August here. We're trying to see how much it's going to change from cash to accrual. James runs a graphic design business and operates on a cash basis. During the month of August, the following events occurred. On August 5th, James made $25,000 in sales on credit, but did not receive any cash for these sales by the end of the month. On August 15th, James collected $12,000 in cash for part of the credit sales made earlier in the year, so not in August, but they were made in previous months. On August 20th, he received $8,000 in deferred revenue for a design project that will be completed in October, and he hasn't done any work on the project yet. So based on this information, how different is the accrual income going to be from the cash income? Now, again, we've talked a lot about this, and I think that based off what we've talked about, you should be able to do the calculation yourself. So pause the video, do the calculation, figure this out, and when you're ready, come back, we'll look at it together. All right, here we are at the answer. The answer is A. The accrual basis will be $5,000 more than the cash basis. So let's walk through this. Accrual basis accounting recognizes income when it's earned, regardless of when a cash is collected. The sales on credit would not be recognized under the cash method, but the full $25,000 in sales made on August 5th would be recognized under the accrual method. So we need to add this to the initial cash basis income, which currently is 0. The $12,000 cash collected from previous credit sales shouldn't be recognized again under accrual accounting, so we should subtract this from the cash income, which would have included it. So cash income is now at $12,000, but the accrual income already accounted for that $12,000 previously, so we have to subtract it to get to the correct accrual amount. And the $8,000 in deferred revenue is not recognized yet under accrual accounting because the project has not been completed, so this would need to be subtracted from the cash basis income. Because the cash basis income says, I got $8,000, I don't care if I've earned it yet, I received $8,000. So cash basis income, if you're paying attention, has $12,000 and $8,000, $20,000 is the cash income so far. But if you're doing the accrual, you take the $25,000 credit sales earned, you subtract the $12,000 of cash received for credit sales already recognized, and then you subtract the $8,000 of deferred revenue that's not earned because you haven't earned that revenue, so you can't recognize it under accrual accounting. So if you do the math, that's $5,000 left, and that's the difference. That's how much higher the accrual income is going to be compared to the cash-based income. Now, I know we went over a lot in this video. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up, the things that they're trying to teach you. They teach you rules about how to treat accounts receivable increasing, how to treat accounts payable increasing when it comes from converting from cash to accrual, and different rules. These are the things that keep popping up, so you know they're important. So you take a moment, you write them down as pillar topics so that you can kind of summarize them in your own words and know them for the exam. So let's go to the pillar topics for this video. All right, here we are at the pillar topics. And again, this is kind of a summary of the most important things you were supposed to learn from the questions. Let's start with the difference between cash and accrual for revenue and expenses. I think this, by the way, this is the main thing you need to keep in mind when you're doing this. If you can understand this, then you will know naturally why the other pillar topics make sense. Cash basis recognizes revenue and expenses when cash is received or paid. Accrual basis recognizes revenue when earned and expenses when incurred, regardless of when cash is exchanged. So keep that in mind always when it comes to converting from cash to accrual. That's why we have to do these different conversion calculations, is because of how they treat income and expenses when it comes to cash compared to accrual. So with that in mind, these make sense. Treatment of increases and decreases in accounts receivable. An increase in accounts receivable is added when converting from cash to accrual, as revenue is earned but not yet collected. So according to accrual, it's earned, so they can count that as income. But according to cash, it's not collected, so that's why it's going to be an increase for accrual compared to cash. And a decrease in accounts receivable is subtracted as cash was collected for revenue already recognized in prior periods. Again, when you're thinking about accrual, accounts receivable already recognized that income. But for cash, they're only just now recognizing it, so we can't double count it, so we have to subtract it when we're going from cash to accrual. Treatment of increases and decreases in accounts payable. An increase in accounts payable is subtracted when converting from cash to accrual, as expenses were incurred but not yet paid. So again, according to accrual, when that accounts payable went up, that means that is more expenses according to them. So that's a decrease to the net income compared to the cash, where they haven't paid those expenses yet, so that hasn't come out of their income yet. And for a decrease in accounts payable, this is added, as cash was paid for expenses already recognized in prior periods. Because again, under accrual, accounts payable has already recognized that expense. Cash is only just now recognizing it. So to avoid double counting, we add back that expense because, again, we've already recognized it compared to cash. Now, another calculation that you may see in your review course or that you may think of, and this is another way of doing it, you can calculate accrual income based off of cash income with this calculation. You take the cash basis income and you do this for any of the receivable or liability accounts. So you can do this multiple times. You take the ending accounts receivable less the beginning accounts receivable, and then you do the opposite with the accounts payable. You take the beginning accounts payable and subtract the ending accounts payable. So you can do it the way I showed you, where you always subtract the beginning from the ending, and then just based off of that being an increase or a decrease and it being an accounts receivable or an accounts payable, you know how it works based off of these rules. But another way to think about it is, for accounts receivable, you take ending less the beginning, and for accounts payable, you take beginning less ending. And that will help you know how it is added or subtracted from the cash basis income. Now, with all that, those are the pillar topics. Again, I know we went over a lot in just 5 questions. This was kind of a long video. However, if you found it helpful and you like what we're doing here, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. There's a lot more where this came from, and we not only have these videos, but we teach you strategies on how to study so that you can pass the exam without wasting time or even extra money. So make sure you go check out that webinar. And again, if you like this, remember that Superfast CPA members have access to the full 10-question video, which we post in the members forum. So you can get more practice and more understanding by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.